Companies Act. A special presentation by The Firm.
I've said it before and I'll say it again. If there is one section in the Companies Act 2013 that India Inc. wishes did not exist, it is Section 188, related party transactions. Well, some of that corporate complaining has hit home. Last week, the Ministry for Corporate Affairs amended the rules governing related party transactions. The key changes pertain to those transactions that are not at arm's length and not in the ordinary course of business and hence need shareholder approval via a special resolution. Now, the MCA has deleted a capital threshold, which will result in fewer related party transactions needing shareholder approval, but the transaction thresholds have been lowered, and that means more transactions that India Inc. would have liked will now have to go to shareholders for approval. What will be the net effect of these changes and changes that have been announced previously? And how does the Companies Act regime of related party transactions sit with tax law? To discuss that, I have with me on Companies Act this week, Sudhir Soni and Darpan Mehta. Sudhir, Darpan, thank you very much for joining us on the show. Sudhir, before I get to the most material change that has taken place over the last weekend, on related party transactions and the changes in thresholds, there have been several other changes that have taken place ever since the Act was notified and this section was brought into force. Do you want to run us through very quickly on what those changes were and therefore what the impact on companies has been?
That's right, Menika. I think there have been several changes, but these are more in the nature of corrections or clarifications to the law. The first was the issue of common directorship. So if you had a director who was on two public companies, then the interpretation was that both the companies would become related because of the use of the words and or in the Act. So that was corrected, and now the test is for both common directorship as well as having a 2% shareholding in paid-up capital. Right. The second order extends the scope of related parties by now including relatives of directors or managers if they have an interest in a private company, then even those companies would be covered in the scope of related parties. So that actually is not a concession that has added to the scope of...
That's an expansion, in fact, of the scope of related parties.
The third clarification was on who can vote in a shareholders meeting, and there was a lack of clarity in the law as it was drafted.
Just poor wording more than lack of clarity, to be very honest
that all related parties cannot vote. So it's now been clarified that it's only the related parties to the transaction who can vote in that. The other was on compromises, arrangements, mergers and amalgamations. The question was whether those are also covered under Section 188 because they involve transfers of property and assets. So that's been clarified now that those are not within the ambit of 188, and I think rightly so because there is a process in the law for those transactions. The other clarification was on independent directors. If independent directors of a holding company were on the board of a subsidiary, they may not have been treated as independent on the subsidiary company. So that's been clarified.
Okay, fine. So that's a quick summation. Private companies, there are some exemptions that could likely be extended to private companies. So if you in fact look at the draft notification that the MCA put out several weeks ago, it did seem to imply that private companies might be saved from the entire impact of Section 188 altogether. Then there is another sort of final notification that's doing the rounds that say, no, it's not going to be an absolute save, it's going to be a partial save, and only in certain circumstances will private companies not come under the purview of Section 188. What do you make of that change?
That's right. I think one would have liked to have a full exemption for private companies from Section 188. Unfortunately, this law doesn't distinguish clearly between entities where there is public interest or not, and therefore I do agree that you should still have some restrictions on private companies which have public interest in terms of loans from financial institutions and so on. So probably you do need to maintain some restrictions, and so I think the two exemptions are good.
The two that we think might be the final outcome of all of this.
That might be the final outcome of those.
I know you look at this from a tax point of view, Darpan, but nonetheless, if you want to weigh in on some of the changes that have taken place and whether they do the business of full clarity or not.
Actually, I think Sudhir's covered it quite clearly. But the other point was for listed company, nothing really has changed. If you look at the SEBI listing guidelines, so while they are not in effect today, companies are still preparing to implement them from October 1. and the thresholds there are the same they were when they were notified in April. The coverage of related parties is as wide as it could be in the Companies Act and even wider, and even the coverage of transactions is wider than the Companies Act. So if I look at it, if I'm a listed company, independent director, a lot of this is discussion, but when it comes to SEBI, it's wider, it's more onerous.
Let's get to the most material change that has taken place over the last weekend. Simply put, they've changed the transaction thresholds, determining which transactions, or rather the thresholds determining which transactions go to shareholders for approval. The threshold with regards to capital size, that's 10 crore rupees or more, has been done away with. But on the other hand, transaction thresholds have been lowered. What is the net effect of this, Sudhir?
Yeah, I think it's a very positive development. It will make the section more easy to comply with. Removing the paid-up capital threshold was very low at 10 crore rupees, and it would almost mean most companies would actually have to go to shareholders.
I think the entire listed universe, or at least the top 100 companies in this country.
Yeah,
right?
if they failed the test of ordinary course of business or arm's length, then almost surely they would have had to end up with a shareholder approval requirement. So that will now not be the case, and I think the transaction thresholds are quite reasonable.
Would you say now that even 100 crores is too low a transaction threshold? Because I've heard many in India Inc. over the last week complain saying, well, this goes some part of the way, but not the full way. 100 crores still means that a large number of transactions will have to go to shareholders for approval. Or would you say that, to be fair from a governance point of view, 100 crores is a fairly good limit?
Yeah, I think it's a fairly good limit, considering that we have, as I said, a hurdle before that. So it's not as if all transactions over 100 crores go. You first have to cross the test of it not being in the ordinary course of business and not an arm's length, and then you realize that a lot of transactions don't even come to that stage.
Yeah, I agree with Sudhir on that. I think that's a good qualitative hurdle. Of course, the subjectivity it brings with it creates a challenge of who wants to take the call on whether it's ordinary course or at arm's length. But if the management is comfortable, if the board of directors are comfortable, then very few transactions will not pass that hurdle, and then the kind of transactions that will go, if they're above 100 crores, then it's fair to get the shareholders to have a look at that.
Yeah. For example, transaction like a sale of property. So, I mean, if it's 100 crores, I think is a reasonable number to test for, and you say if it's
and
over
they also have the 10% threshold. So it's not that companies who are not large don't have to comply if it's below 100 crores. If it's 10% of their turnover, they still have to comply.
Whichever is lower.
Whichever is lower.
Whichever is lower, right. So if it's 10% and that is lower than 100 crores, then in that case, then that will still have to go to shareholders for approval.
Which goes to Sudhir's point. You are protecting the shareholders' interest by specifying.
Fair enough, yeah. So I remember through the course of this series, every time we've discussed related party transactions, either with company lawyers, CFOs, auditors, tax professionals, they've all said that, actually Section 188 is going to be counterproductive, because the number of transactions that will go to shareholders for scrutiny will mean that the focus that shareholders need to have on potentially abusive transactions will get dispersed over having to read through many, many transactions. I remember the M&M CFO telling me, Menka, my related party transactions list that might potentially have to go to shareholders will make up 20 pages of single line entries. So shareholders to go through 20 pages, understand all of that, decide how to vote. Will this change mean that fewer, sort of transactions will go to shareholders, therefore they can focus on the more material ones and hence spot the potentially abusive ones, more effectively?
So unfortunately, I think this change is, though it's been done in the Companies Act, we're not sure whether SEBI will follow. And, if you look at the SEBI threshold, which says material related party transactions, and they do not have a hurdle of ordinary course of business or a test for ordinary course.
There's no exemption for those.
Yeah, so I think unless SEBI were to change the revised clause 49, we still will face the issues that you've mentioned.
So what will they have to do to change the threshold to bring it closer now to what the MCA thresholds are? Because they don't offer any exemption for, arm's length or in the ordinary course of business transactions.
Yeah.
And their materiality thresholds are 5% of turnover and 25% of net worth.
That's right.
So how are they going to be able to align those thresholds to the new thresholds that the MCA has introduced?
Yeah, I think what SEBI will need to do is first actually introduce this threshold, or actually introduce a hurdle within the revised clause 49 to say that only transactions which are not in ordinary course or
so they need to offer the same
exemption.
exemption.
They need to offer the same exemption. Otherwise, if you have a company selling to its subsidiary, and they sell through a subsidiary, let's say, then you need to take that transaction to the shareholders, which doesn't make sense.
What do you make of that, Darpan?
So I agree with Sudhir, but The point that you made, which is a larger point, is that will shareholders have to actually dwell on something like this? And let's assume SEBI doesn't change that, and one hopes they do. My sense is that the purpose was really to have independent directors take up that responsibility. So if the audit committee and the independent directors are going to sit in judgment on whether the transactions are in the ordinary course of business, are at arm's length, and they would anyway report them to be so in the board of directors report, and there will be a fair bit of disclosure. So the expectation from the larger group of minority shareholders is that these independent directors have discharged the responsibility cast upon them, because there are implications for not doing so. What the shareholders will see is that they will see a discussion in the board's report on why these transactions are considered by the independent directors or the audit committee to be in the ordinary course of business or to be at arm's length. And I think that if you see the quality of disclosure that is required in the board's report, the forms that their companies are required to file, there'll be a fair bit of information. And I think I'm just thinking aloud, if I was a shareholder, I would have the expertise to question everything, unless it's very patently abusive. There are some examples of that as well. But if I get that quality of disclosure, and if I get the comfort that there is a good set of independent directors there, and that will become the test of which listed companies are going in that direction, and they're giving that comfort to the shareholders. So I don't see that it's going to overwhelm.
Companies Act, a special presentation by The Firm.
Darpan, can you explain to me what exactly not in the ordinary course of business and not at arm's length means? Because these two phrases have several companies and their finance teams confused as to how to distinguish between one and the other, and whether they can borrow from tax law and apply the same to Companies Act and say, okay, if tax law considers this at arm's length, then I can consider it at arm's length as well, and not have to send it to shareholders.
Even as a transfer pricing expert, I would say, though I can apply transfer pricing principles, it is actually quite subjective. So the immediate reference point is clearly the income tax law, and I just wanted to put that in two buckets. The first bucket is what reference can you draw from the income tax law, and what additional flexibilities can you take beyond the income tax law. So interestingly, and just spending a moment on what the income tax law looks at, it actually looks at the transaction price. Whereas what the Companies Act talks about is that the transaction should be conducted at arm's length. Price is just one of the factors. So whether the transaction should have been done at all or not, you ask that question for the loan. That's broader in the Companies Act. So if you're talking about a transaction being at arm's length, the pricing part is looked at in the Income Tax Act in a holistic way, but in the Companies Act, that's going to be a focus as well, apart from why the transaction was done in the first place, and the Board of Directors can ask that question. So that's if I focus now on the pricing, then clearly the Income Tax Law has a Section 92. It has a transfer pricing section which has been there for 10 years, and we'll talk about the litigation on that and what that impact has. But the code is a fair code. It's aligned with international guidelines. There are some deviations per se, but it's broadly aligned with the international guidelines. The practice of it by the income tax authorities has been a challenge. But if I apply the code in spirit, then it will help me to give comfort. If I'm the management, it'll help me to give me comfort to my audit committee or my board of directors or my shareholders that I've applied this guidance under the Income Tax Act. These are the various things the Income Tax Act Section 92 requires me to look at when I'm evaluating whether a transaction is at arm's length or not. And here's the analysis I've done. What are the functions and risks of the parties? What are the terms of the transactions? What's the credit period? And what are the margins each party is earning? What is the past data? Do I have any third-party alternatives? So the code is actually quite robust, and there are some constraints. So I'll come to the constraints then. So when I look at the constraints, the Income Tax Act talks about testing the transaction after it has happened. So it says that you've done a transaction, and it looks at the transaction for the full financial year. So you can aggregate similar transactions, even if they're happening across multiple parties, which is a flexibility the Companies Act may or may not give you.
Right.
But the Income Tax Act looks at a series of transactions which are similar, it aggregates them, and it tests whether applying one of the 5 methods, the margins earned from those transactions are at arm's length or not. The Companies Act requires you to get the transactions approved before they happen.
the transaction takes place.
So
I think timing is important.
Timing is important.
So how do you resolve or reconcile that?
So what you do is you apply the principle, but the data that you would use or the inputs that you would use would be the past data.
Okay.
And while
But that would only help if it was a recurring transaction, right? If it's not a recurring transaction, then
you would, so let's take the example of sale of a business or
Right.
sale of an undertaking. Even in the Income Tax Act, when you have to test whether the transaction was at arm's length, you will actually in practice produce a report which is done by an independent valuer, applying one of the appropriate principles of valuation that are relevant for that transaction of sale of undertaking, and you would conclude that that transaction is at arm's length. That's not going to be different under the Companies Act. You'll probably do exactly the same thing. So there's a fair bit to borrow from the code, but some constraints and two that come to my mind is, one is the Income Tax Act says you should look at only the current financial year data of the benchmarks. I'm not going to be constrained by that when I'm giving that comfort under the Companies Act. If I think it's more appropriate to look at 3 years data or 5 years data, I think we should use it. That flexibility we should have. The Income Tax Act says arm's length means within the arithmetic mean. At the arithmetic mean or within a range of the arithmetic mean. This is contrary to what the international guidance is, and India is going to change that too very soon, which has been announced. But irrespective of that, even if that was not the case, I would have actually gone to the international guidance, look at interquartile range, and applied it for the Companies Act. So while the code is there, the spirit of the code is there, you also have reference to international transfer pricing guidance, and I think combining that, management can give comfort that broadly this is at arm's length.
As an auditor, are you comfortable, Sudhir, with the companies determining whether a transaction is at arm's length or not by applying tax law principles, to the transaction for a Companies Act purpose?
Yeah, so I think the tax law is a guide, but as Darpan's explained, that from the timing of the transaction, you cannot follow some of the classical methods that they use in tax. For example, the transaction net margin method, which actually aggregates transactions and you calculate a margin at the end of the year.
Right.
That sort of a method is not probably what is likely to be applied in the context
because you'd have to look at each transaction individually,
you're looking at
right?
each transaction, each contract, and each customer or each party with whom you're transacting.
Right.
So you don't have that level of aggregation. But otherwise, the principles in tax are certainly those which we can apply. For example, the comparable uncontrolled price method, that I think is certainly the best possible method that you can do. Or you have, in fact, the tax law's other methods. So you have a choice. In fact, the good part of the Companies Act today is it's not prescriptive on what is the basis to determine arm's length. So I think it is a determination made by the judgment of the directors in the meeting, and I think as long as they can document the rationale for their decision.
It would be fabulous, because now directors have to be tax experts as well to be able to understand whether the right principles are being applied from tax law in making this distinction about arm's length and in the court.
Right.
In the ordinary course of business is still something one can apply common sense to, right?
Yeah.
But arm's length is fairly technical, so you have to be able to understand tax principles to be able to apply the same here and say, look, I agree with management, this is at arm's length, and therefore I don't think it needs to go to shareholders. That's going to be terribly complex.
In fact, I think one of the biggest concerns that companies face today is this requirement of prior approval by audit committees.
Yeah.
And that in section 170.
No, I can see why exactly, right? Because this is a difficult call to have to make, right? I have a question, and it might come out incorrectly or too simplistic. But Darpan, for instance, from what I understand, both international and domestic tax principles sort of lay out, if you are offering a guarantee to a group company, what the cost of that guarantee should be, right? And if you meet those requirements, then your transaction is considered to be at arm's length, and so then you're on the right side of transfer pricing law as opposed to the wrong side. Now, if the same cost or if the same benchmark was applied to whether you were considering whether a guarantee must go to shareholders for approval or not, so you're well within the right side of the transfer pricing law when it comes to the cost of that guarantee, would you by extension then also be at arm's length when it comes under Companies Act? Can, A be equal to B?
That test needs to be applied at least at a party and a transaction level. So if you are saying I'm satisfying the test under tax law on the basis of an aggregate of transactions across...
No, so aggregate we've dealt with. I'm saying an individual transaction.
Yeah, then it is quite likely that it would meet the test even for the Companies Act.
So you can apply the principles almost on an equal basis, so to speak, for Companies Act.
That's right.
Okay.
Just want to add one layer to that, which is, while the Income Tax Act talks about the pricing, he can always question why did you do the transaction in the first place. So arm's length means not only the pricing, but whether you would have done that transaction.
I get that. That you raised right in your first point about what would you consider. And I think arm's length is not necessarily just pricing at arm's length, but doing the transaction at arm's length in all other manners. Okay, I think that gives me a fairly good idea of where we stand today when it comes to RPT. Since we're at the end of our time, let me ask both of you to summarize in a sense what the net effect of this Companies Act, with all the changes that we've seen happen in RPTs, what is it going to mean for companies? And I'm talking, for across large listed companies, private companies, based on what exemptions they get. How are they going to deal with this here onwards?
Yeah. I think if the private companies get the exemptions that are proposed, either in the first draft or the second draft, then things should be relatively easier for them to comply with. For the listed companies, if you put the Companies Act and the SEBI law together, I think it is still a challenge. And,
unless SEBI puts in both those exemptions, which is in the ordinary course of business and at arm's length.
And at arm's length. Even there is still one challenge, and that is the prior approval by audit committees. So audit committees are beginning to feel extremely burdened by the transactions that could come to them. There is a possible interpretation there, and if I can take a minute on this, is that an audit committee is a subcommittee of the board of directors. Essentially, if transactions are not in the ordinary course of business or not at arm's length, it's only in that situation that they go to the board of directors.
Right.
And so there is a point of view that only
Why
such transactions should go to the audit committee, because you cannot have a terms of reference of the audit committee beyond the reference of the board, which I think is a logical interpretation. If that is the case, then the burden on the audit committees would also be lesser.
Okay.
So that is one. I think the second thing going forward, is probably one of the relaxations that one should look for, is if wholly owned subsidiaries
you want
could
even
be
more relaxations.
Yeah, I think so. I think in the definition of related parties, I'm surprised to see why wholly owned subsidiaries are treated as related parties.
Yeah,
because
many people have brought this up.
Yeah, because
when
if
you're transacting with a 100% subsidiary, why do you have to go to shareholders for approval,
Absolutely.
if at all, right? Yeah.
That's right.
Fair point. Darpan, are you going to spend most of your time training board members to understand transfer pricing principles and therefore understand what arm's length is all about?
Yes, and but you asked what's the key takeaway, and I think it's about the documentation, which is probably the effort that listed India is looking at, and it's actually, and I agree with you, it's a little overwhelming, but I hope that it's one time, in a sense that if 90% of the transactions are recurring, then we're going through a transition phase where this one-time effort will cover 90% of what you need to comply with in the future. And if something's out of the ordinary, something's abusive, then we've said it earlier, we want corporate governance, we want shareholders to look at it, and if it needs to go through the rigors of the law, then let it go through that. So, really, that's the optimistic future I'm looking
Your clients are going to beat you up for saying that. Darpan, all the best. Thank you, Sudhir. Thank you both for making this a little simpler for us to understand. And thank you very much for watching. We're coming to the end of our series on Companies Act. So if you have any suggestions on issues that you think we should cover but we haven't yet, please write in to us. Otherwise, we'll see you next weekend with the finale episode.
Companies Act, a special presentation by The Firm.